Hey everyone, it's Mayhem and Ayesha here from Trader Aid, and we're going to talk a little bit about what we're seeing in macro and markets, starting off first with Jackson Hole. Ayesha, what did you think about that speech from Powell? It was short, it was to the point, it seemed like he didn't want anyone to mistake what he was saying.
No, absolutely. Hi, everyone, first of all. It was quite a surprise. I mean, I turned it on and it seemed like it just whizzed by and, he was walking off stage. I think I think it's probably one of the shortest speeches he's ever given. But you're right. I think what he was trying to get at was probably something to the effect that this is what I'm trying to say. Please don't, misunderstand me. Please don't misinterpret my words. And this is how it's going to be. So yeah, I think he hit the nail on the head very well.
I do too. I really felt like, he didn't even do a Q&A either, which was a departure from his style as well. And I felt like that was further adding to the idea of, I don't want anyone to misinterpret anything I'm saying here. We're going full hawkish tilt. We're going to inflict some pain, as he said, and we're not going to stop until the job is done. And I felt like that sort of misinterpretation in the markets that we saw from the July meeting, where people thought this is the pivot. Powell is saying we're data driven, we're reaching this neutral rate, and people started to think, oh, okay, now the Fed's going to turn around and at least stop their hiking and maybe even start cutting. While meanwhile, in September, we're set to see a doubling in quantitative tightening with bonds rolling off the balance sheet in the amount of 60 billion a month, or up to 60 billion a month from the prior limit of up to 30 billion a month, and mortgage-backed securities rolling off the amount of up to 35 billion a month, up from 17.5 billion a month. And this is all happening at a very interesting time, because the Treasury has said that they're upping their debt issuance by 2.5-fold to 444 billion for the third quarter, and similarly, we could probably expect something of that size in the fourth quarter. So supply is increasing, demand is decreasing, not just from the Fed, but other counterparties that were pretty important buyers like Japan and China were distributors of treasuries for much of the first half of this year. So it feels like we're going into a little bit of a paradigm shift. What are some of the things that you have that you're keeping an eye on as this is unfolding?
So I think obviously we're looking at earnings. We're almost at the end of earnings season, tail end of the earnings season. And the one thing that we've been tracking all throughout was, how companies are sort of responding to the market changes. And what's surprising is this quarter, we were meant to see probably a lot of, companies gapping down. We were meant to see a lot of, negative earnings, misses, quite possibly even, even some of the big tech faltering. But surprisingly, what we've seen is just the opposite. And we've seen most companies beat on estimates, particularly EPS estimates, not revenue so much, but bottom line beats were, across the board, and they were much higher than expected. And my only thought about this is I think the analysts were too conservative. I think they underestimated what these companies were doing. I don't think they realized how much they had actually increased pricing. And all of that sort of counteracted, the results. And as a result, what we're seeing is companies actually doing far better, and people, stock prices just started to soar, which, kind of started the rally, so to speak.
Right, and it was an interesting rally from that mid-June low that we saw, and I feel like when we go underneath the surface, there were some flows that were worth examining there too that sort of drove this. So we had that, as you said, analysts underestimating perhaps way too much for some of these companies, driving some of these pops, and then we saw just a lot of short covering, momentum traders getting long, passive flows from dealers bidding up the market, and a lot of retail participation too in some of their their favorite sort of meme stocks. And, we're retail too, but I differentiate a little bit here just because some of the stuff that's going on is not really what you want to see. It's the sort of speculative fervor, the mania that got this market into a lot of trouble earlier this year in the March bear market rally, as well as last year during the February and November options driven rallies and a lot of these unprofitable growth in meme stocks. And we saw almost the exact same pattern play out. And we were both kind of raising the red flags as this was happening, saying, hey, wait a minute, this isn't what you want to see if you believe this is an extension of the bull market that, we already think is dead, or a new bull market that started to become sort of the theme that people are using to justify this pretty long 2.5-month bear market rally within the context of one of the worst starts to a year for equities ever. And it started to feel like, people were being conditioned to believe this. Bulls were starting to believe this was indeed a new bull, or at least a continuation of the existing 13-year bull that we, again, believe has died. Or bears started to capitulate and say, you know what? I can't be short anymore here. This looks convincing. And even the Wall Street Journal came out with an article that almost marked the top of the rally, saying the NASDAQ is now in a new bull market. We're up over 20%. Now, if we go back to the dot-com bust, there were several, quote, new bull markets that were born and died during that bear market post dot-com crash. So, the NASDAQ being a higher beta index, it moving up 20% off its lows. In my opinion, I'm sure you share this too, Ayesha, it's not really a new bull market. It's just a very high beta index kind of fluctuating during a bear market rally. And this is all in the context of unprecedented velocity of tightening, right? We've seen central banks around the world pulling back their liquidity, raising rates. This all has a big effect on price discovery in risk assets, but not just risk, also in debt, also in, in real estate, and also in things like crypto, which I'm careful not to call an asset. But it seems like we're kind of in this place here where, after the last 13 years of people believing that the Fed always has their back, that the Fed's selling puts at a certain strike price that's not too below where the market is now, that mentality is kind of prevailing here, right? That there's sort of this disbelief that the Fed can do what they've set forth upon. Even after Powell's speech, we see a lot of that out in the wild. What do you make of that, Ayesha? What do you think is kind of driving that, and what might correct that? Because right now, retail has the highest component portion of their net worth in equities that they've ever had, and typically in previous bear markets, that sees a washout, but we haven't yet.
I think investor psychology has changed massively. So what I'm seeing even on the ground over here, for example, when you say retail is not just people who've jumped in the market, the young people, the young crowd, who are using Robinhood and, that, like, the gamification of trading. It's not just those people, but I think there's a whole cohort of, our generation, or even people older than us, who just decided to sort of pull their money from fund managers, pull their money from, money managers, and start to invest on their own. And I've seen this personally as well, where people have decided, if they can do it, why can't I? I mean, it's easy enough to open a brokerage account. It's easy enough to put in money. And guess what? When people started piling into the market in 2020, anything they touched started to go up, right? So it sort of fueled this addiction, if I may be liberal with the word, but it sort of fueled an addiction to trading, and people started over trading. And there's still a lot of that. Buying options is so easy. It's like, gambling, so to speak. But it's just become so easy for people to do these things online or on their phones. Most people don't even look into I know people who don't even always look into charts, who don't even know how to read charts, and they'll just buy a stock because they heard it on the news, or they heard it even, God forbid, on CNBC, and they'll just decide to put their money in there. The problem with this then becomes that you start to think this is how it's always going to be.
Right.
And even though, and I think something you and I had discussed over the last couple of days after Jackson Hole. I felt like, or rather, we both felt like Powell was a little upset,
Yeah.
that people were not taking him seriously. There is no Fed pivot coming. He's not going to stop. And I think he tried to make it as clear as possible that, it's not what you think. We are going to tighten, and we have to. There's no other choice. I don't think a lot of people have, lived through times like this. I mean, he clearly quoted Volcker, and we were just too young at that time. But we've seen bear markets before. You and I have, but I don't think the majority of people have, even if they were old enough. They probably weren't trading at that time, or they weren't in the market at the time. So this is all very new to people. And so I think there's been like a huge shift in psychology. And I think people are just, naturally euphoric and just trying to hold on to some misplaced optimism, thinking that, the market will continue to go up.
Yeah, I couldn't agree more. You've made some excellent points there, really across the board. One that I wanted to talk a little bit more about is with the Fed raising rates and with so much options-driven participation, particularly on the call side in equities, this deleveraging that has to happen. We haven't even really seen it kick into full gear. We saw some degree of it from November until July with the margin data that we have so far. That same margin data suggests the S&P needs to correct lower to kind of keep tracking that positive correlation it has with margin, and similarly with the aggregate size of major central bank balance sheets. And so what we're seeing is likely this record tightening, this unprecedented tightening, not just from the Fed, but global central banks. And I know some people might say, well, they haven't really tightened that much in terms of rates. No, but in terms of the velocity of change, this is one of the most aggressive tightening cycles, and we're not even factoring in that quantitative tightening. So it seems like we have this psychology that's been built up. Like you said, there's this sort of very forgiving environment that we've existed in for a long time, where you could pretty much throw a dart out on a list of stocks, and in 2020 you'd make money. But even for much of the last 13-year cycle, it was similarly possible to just sort of blindly buy and do pretty well, particularly from 2012 on, when sort of mega cap tech started its decade-long move. And I feel like this is setting us up for a pretty dangerous environment because, A, like you said, risk is not appreciated. There's a sort of almost foaming at the mouth optimism that every dip has to be bought because the Fed has our back. And even today we saw some of that impulse as the market opened. There was this big surge of incoming buys into things like Bed Bath and Beyond, and other kinds of meme stocks were rallying this morning. There was a short squeeze in NERV, and it just seems like there's still that sort of relentless optimism. And don't get me wrong, optimism is fine, but it should have some basis in reality, in logic. It's fine to be optimistic about where the economy is going to go or where the market's going to go, but we shouldn't necessarily be optimistic in the face of the Fed saying this is going to get worse, the economy telling us this is going to get worse, earnings and guidance telling us this is going to get worse, and charts telling us that this is going to get worse. Pretty much the convergence of fundamental, macro, and technicals all agree that this is a bear market rally that is unraveling and could become much worse, and wouldn't be too surprising to see new lows in this. And one thing, Ayesha, that I thought was particularly interesting that came out just last night, the ECB is now starting to discuss a 75 bips hike in September. And this is on the back of Jackson Hole. So it's almost like they're starting to say, hey, look, and a couple of their members actually said this, that they're concerned about their currency now. They're starting to become more concerned about the trajectory of the euro now that it's below parity. And that could be one of the drivers for their monetary policy as well, because one of the reasons currency pairs get priced like this, for everyone out there listening, is disparities in rates and economic performance. Well, the Eurozone is economically weaker than the United States. Their rates are meaningfully lower. And while their central bank has been kind of chattering hawkishly a little bit here and there, this shows that maybe, in fact, they're somewhat serious about this. And if they are, it's sad as it is to say, this will be deleterious to the Eurozone because they can't hope to fight these supply-driven energy constraints that are one of the biggest catalysts of inflation by destroying demand. It's people are still going to need heat in winter, whether or not rates are where they are now or higher. And similarly, industries are going to need to manufacture, whether it's somewhat less. It's not not going to have as big of an impact. So we're seeing this energy shortage in Europe have a big effect. It's actually having an effect indirectly on agriculture, as a lot of manufacture of ammonia, which goes into fertilizer, is being shut off because of an inavailability of natural gas. And it just starts to feel like, these central banks are fighting a almost impossible uphill battle, especially in the Eurozone. But it's not much better here, because we both know, and we've talked about this, the Fed can destroy demand. In order to do so, they need to basically create an environment with a rising cost of capital, with a slowing economy, where we see deleveraging, not just in the market, but also from the corporate side, where we start to see people lose their jobs, unfortunately, where we start to see factories shut down, where we start to see, companies really manage risk much more carefully. That slows the economy. That does slow demand. But the problem is, the structural inelasticity on the supply side will only grow in that type of environment, because if you're a producer, you're an explorer, or you're a transport company, you're not necessarily going to be investing more capital as the cost of capital rises, as the cost of labor remains sticky to the high side, and the economy and business conditions are deteriorating. So it feels like, in the short term, the Fed can get the job done, right? There's more pain to come, as Powell said. But over the long term, doesn't it seem like some of these inflation issues are becoming structural in nature?
I think so. I think it's going to become like a vicious cycle, right? I mean, it's exactly what you're saying. One will feed the other, and I think one thing that he also pointed out at Jackson Hole was, his, let's say, displeasure with the labor market. I think by now he probably, I mean, they've always been saying that the labor market is very tight. And so therefore, it sets the stage for them to tighten aggressively. But I think the response coming out of the labor market now, in terms of unemployment still dropping, is something that they didn't expect. And he clearly said that there was an imbalance in the labor market. So as they tighten further, and one thing that you pointed out in terms of QT, for example, and you keep saying this, no one has successfully done QT ever, right?
Yes.
And Powell kind of tried it in 2018, and they kind of failed, right? So I think he's very cautious to use the words QT. If you notice, he never does. Almost never. I don't think I've ever heard him say it. And I think he's very cautious about talking about the balance sheet running off because of what happened last time. It's left a bitter feeling in his mouth. I mean, the US was headed for a recession, and they had to reverse course, and it was a mess, right?
Yeah.
And this time around, I think with inflation this high, he has no choice but to do this. But for some reason, the labor market is not responding the way I think they've expected. And unfortunately, growth is slowing, but the labor market is still very, very tight. But going back to your point, when this starts breaking, when I think, we see a point where the labor market remains tight, and suddenly we start to get unemployment rising. And when it starts rising, I think it's going to start rising very, very fast. And it's going to be like a massive domino effect, and not just in the US, but across the world. I mean, look at the emerging markets. Many countries are on the brink of default. And Europe itself is in such a precarious position. I mean, they've had low rates forever. And most of their countries were already on the brink of default. And now I think even the bigger economies like Germany and France, the UK is out, of course. UK has its own problems. They're suffering. And I don't think that Germany and France can be the savior to everyone, like they were last time. They can't start bailing out people. And if Europe can bail out people, and if the US cannot bail out people, if Canada cannot bail out people, what's going to happen to the emerging countries? They're looking for a handout. Many of the countries are looking for a handout. Where's that going to come from? It baffles me. I have no idea.
Yeah, I think that those are some really important points there. The labor market one, I think, is fascinating because remember last year, Powell kept talking about social equality and slack in the labor force participation rate and all these folks that never kind of got back to work. And that was one of the reasons the Fed kept pounding the table on this easy policy that they kept easy for probably far too long. But the net effect of that is that you create these sort of wealth effects that can keep people out of the labor market. And as they reverse those wealth effects, we could have a whole lot of new job applicants coming in at the same time that JOLTS is falling, that new job openings are continuing to fall because of, companies basically pulling back. We see major companies that leased out too much office space, that hired too many people, that are at least stopping the hiring, if not starting the firing. So I think you're absolutely right. Unemployment could surge rather quickly when that vicious cycle starts. And it typically does start with a drop in those job openings, which we're already seeing. So I'm 100% in agreement with you there. I also found it was fascinating that we saw more, like a record number of people working two or more jobs. And that's something that skews some of that employment data as well. So, it's definitely a unique environment. The part that you talked about with regards to Europe, I think this is something that we need to pay attention to with regards to both Europe and also emerging markets. With Europe, we have sovereigns that have far too much debt and they cannot sustain that debt in a rising rate environment, particularly in the southern component of the bloc. And then when we look at emerging markets, it's double trouble because not only do they have a lot of debt where rates are rising, but many of these countries don't have control of the rates. A lot of these rates are set by benchmarks like the 10-year yield, and then they're having to be repaid in dollars, which are getting more and more expensive. And that's putting a lot of pressure. It would not be surprising. I know we've discussed this a great deal lately. It wouldn't be surprising to see some sovereigns default, whether it's in emerging markets, Europe, or both. And I think that's a danger for that sort of domino. Because if that falls, if we do see sovereign defaults, all bets are off that the bear market is ending anytime soon, that the recession is ending anytime soon. That would have a pretty significantly deleterious impact on the global economy. And, in that light, we also haven't seen anything in the equity markets here or elsewhere that resembles a durable low. These bear market rallies, they're powerful. They're almost, they cause some degree of euphoria because the type of gains you can see in a bear market rally can be much, much bigger than in a bull market. Bull markets tend to climb walls of worry. Bear markets, you tend to see people fall down the stairs. But on the other side of it, those bear market rallies can be really, really vicious. And they're typically powered by a lot of short covering, which was exactly what we saw this time around. So shifting back, though, to the Federal Reserve and their mission at hand, we've seen from the U.S. legislature, new acts like the CHIPS Act, the Inflation Reduction Act, which is probably ironically named, executive orders like debt forgiveness for students, which is going to cost this country something like $300 to $500 billion, and then China's stimulus, which is likely to further add to that sort of global pro-inflationary pressure. This just makes the Fed's job more difficult, doesn't it?
Oh, absolutely. Absolutely, it does. And I think something that he alluded to as well with regard to this was the Fed can only do what they can do. And I think part of, and I don't know what he was thinking, but to me it felt like he's saying we're trying our level best to curb inflation. We're raising rates. We're doing everything that we can. We're bringing pain to the market. We're bringing pain to people. And you, on the other hand, you're pumping fiscal stimulus, so to speak, into the economy. So I think there's a little bit of frustration there as well. That on the one hand, you're blaming the Fed for, not being able to control inflation, but the government is, doing all these things to sort of, stimulate the economy in a different way, right?
Yeah.
So I don't know how they reach a balance. And with all this money coming into the system all over again, let's say, I mean, it started with this, didn't it? I mean, I'm not saying that it's wrong for them to forgive debt, but perhaps not so, not across the board. I mean, there should be I don't know. They should do it in a phased out manner, let's say, because the way that they are thinking about implementing this, I think a lot of people will be left with residual wealth, which will create another situation, as we saw, and it will just drive inflation, as you're saying.
I agree, and I think it has both that sort of intermediate term effect, like you're talking about, as well as a short term psychological impact. People say, "Oh, I don't need to pay this. Well, then I'm going to go out and buy some more goods," which has been one of the primary drivers of some of this inflation that we've seen, because there's the supply chain constraints that make it more difficult to produce and transport those goods, and then there's also unusually high levels of demand for those same goods. So I feel like this sort of stimulus, whether it's the CHIPS Act, the Inflation Reduction Act, or the forgiveness of debt, it just, like you said, it adds to the burden of the Fed, and it also it forestalls any conclusion for this sort of intractable inflation. And I know a lot of folks got really optimistic about the data that we saw, CPI for July showing that there was some softness. Most of that was just energy. Energy's come roaring back this month. So the idea that the peak inflation narrative is something to hang our hat on, I think it's time to be very cautious about that. And I think Powell spoke to that a little bit as well. He said, our job's not anywhere near done. So it feels like, kind of to start to wrap up our conversation here, it feels like this could prove to be a deeper recession and longer bear market than many expect as a result of all these factors and others that are compounding this effect. Are there any concluding remarks or thoughts that you'd like to leave with the audience, Ayesha?
No, I think you're absolutely right. Not to sound, pessimistic, but it is what it is. I think we're going to see companies start to show a profit recession. We're entering an earnings recession. We already have. If you look at quarter on quarter earnings or quarter on quarter revenues, they're declining massively, and I think the pain is yet to come. I think it's going to get worse in the next 2 or 3 quarters. I think this will lead to a broader recessionary environment. It's not just going to be stagflation anymore. We're going to have inflation coming down, but we're also going to have growth slowing massively. So this is definitely going to cause a recession. We're going to have unemployment going up, and we just have to brace ourselves for this.
I agree. I think it's the start of a new paradigm, and it may be one with shorter credit cycles, more shallow bull markets, and inflation rearing its ugly head earlier on and kind of creating that paradigm shift. So for everyone out there, if you enjoy this sort of commentary, we obviously enjoy talking about this stuff. It's a great passion for both of ours to talk about, what's really going on, zooming out and then starting to zoom in from there and talking about all these different points that are in the economy and the markets. Consider checking out TraderAid.com, because one of the things that we do for our members is we don't just provide ideas on how to trade the market. We also try to provide actionable information, research analysis, and commentary that can help to provide a broad-based view for everyone who's interested in learning more about how all these things interconnect and why they matter. As Ayesha and I have always said, macro matters. Whether the narrative is one that macro doesn't matter because one thinks they can ignore it, like from 2020 through part of 2021. The reality is macro has always mattered, because that rip-roaring bull market that we've seen has been entirely powered by macro, by quantitative easing, by artificially low rates, and the reversal of that really and truly matters. So check us out at TraderAid.com. We just launched a Discord. It's just under $50 a month or under $500 a year, and you can interact with our entire team of experts as well as other members on there. It's a great community. But thank you again for tuning in. Thank you, Ayesha, for participating on this this podcast with me, and expect more of this stuff to come. We'll have both free and premium content, because we do want to outreach to larger and larger audiences as we try to build this community, as we try to help more and more people. So we appreciate everyone tuning in and supporting Trader Aid. And if you're not a member yet, again, check us out.